Think deep, trade smart. This video is presented by Meitou Investing. Before I jump into today's video, I want to give special thanks to those of you who commented on the last video. They're really helpful comments and I will do my best to improve them in the future. Recently, the stock market has been very volatile over the past 2 weeks. The Nasdaq Composite has declined more than 6%, and those other companies whose stock price skyrocketed since last year were hit even harder. When the market is down, this is the time when we as investors should be more careful in studying the market and managing our investments. In today's video, I will be sharing my analysis and opinions to the following concerns. What caused this market correction? Was this decline reasonable? What should us, as investors, do in order to respond to this sudden decline? And are there any safe investments remaining in the market? In respect to the market, there are way too many noises. Some people state that this correction is just as normal as it should be and it is the perfect timing to buy. On the other side, some people believe that this is the beginning of a collapsing bubble and there is another bigger correction coming up. The only way to face these noises is to look into the market deeply and understand why all these are happening. I believe that many of you know that the direct reason for the recent decline is the increasing interest rate of US 10-year Treasury bond. But some of you may be wondering, how can a raise of interest rates on Treasury bond can be so impactful to the market? And what are the worries of this raise implied to? Basically, within every mainstream valuation model used by the Wall Street, the US 10-year Treasury bond is normally used as an indicator when counting discount rates for every company listing on the open markets. Generally, when we evaluate a company's market value, we only look at two indicators. One is the amount of future cash flow of that company, and the other is the discount rate. The higher the discount rate means that when a company converts its future cash flow to today's value, the equivalent amount will be lesser. And now with this important indicator being raised by the government, the valuation of all companies dropped as a result. This is a systematic decline that doesn't target a specific company or field, but all of them, which is why we see the entire market is going down after the raise. Okay, I may sound wordy, but really for individual investors, you don't have to know every single step when evaluating a company's value, but understanding this logic behind it is very important. Knowing this logic will not only help you to predict the market change, it also strengthens your understanding of a company's future development. For example, if you knew the relationship between the stock market and the Treasury bond, you should be able to predict the decline based on the interest rate fluctuation and adjust your positioning before the decline. The recent correction of the Nasdaq Composite has to do with how fast the interest rates increased rather than how much it was increased. Correspondingly, the rapid increase of the interest rates has caused worries for some investors that the inflation may be overheated. What does it mean? Well, inflation, long-term interest rates, and the US 10-year Treasury bond interest rates have a very strong positive correlation, and their influences to the company's value are reflected on the discount rate. A rapidly increased long-term inflation will cause investors worries that the Federal Reserve might increase the short-term interest rates as a response to inflation. Despite recent rise of worries, Jerome Powell has stated at Tuesday's Congress meeting that the Federal Reserve will maintain an interest rate close to zero and will continue buying back US bonds. Clearly, the Federal Reserve is still planning to maintain a loose monetary policy and gives us a signal that any radical measures are not in the Fed's concern, especially at this time of the economic recovery. So, I don't think we need to worry about additional policy risk. Therefore, we saw that the stock markets opened sharply this Tuesday, and then it started to rebound after Powell's speech. Although there is no need to worry about additional policy risk, The impact of raising long-term interest rates on the stock market is still significant. This decline is not a normal correction caused by the overheating of the stock market in the traditional sense. The overheating definitely played an important role. However, the systematic decline in valuation caused by the increase in long-term interest rates was more critical. In addition, I think that long-term interest rates will not fall in the short term. As the economy continues to recover, long-term interest rates will only increase. This shows that the increase in long-term interest rates is a relatively long-term event, and it is very unlikely to be digested in the short term. In my opinion, the increasing interest rate is a good thing for the overall stock market in the long run. Raising the interest rate is an indication of economic recovery. Long-term low or even negative interest rates may inhibit economic development, such as Japan in the past. This is exactly why we see that the Fed was expressively hinting that it embraces the increase of interest rate and will not conduct operations to restrain the process. Therefore, I believe that long-term interest rates still have room for upward breakthroughs. But it should also be noted that although the Fed is willing to see interest rates rise, it will stay cautious against rapid increase in interest rates. Because if long-term interest rates are rising too fast, it is a clear sign of inflation and economic deterioration. Therefore, the future growth rate of long-term interest rate is something that we as investors need to pay more attention to at all times. If interest rates exceed more than 2% in the short term, then that is a very dangerous signal. From a macro perspective, long-term interest rates increases are inevitable, and this is a long-term event that will not be digested in the short term. This is good for the stock market in the long term, but it is bad in the short term. Under last year's low interest rate environment, the stock market has overdrawn too many rooms for growth. As the economy continues to recover, while also the economy is driving the stock market upward, the long-term interest rate is pulling the stocks that have been overheated in the low interest rate environment back together. This is a process that the stock markets will go through in 2021. Past week's correction is only the beginning, and similar phenomena will certainly continue to occur in the future. We as investors must be prepared to respond to these potential risks in the foreseeable future. By this point, I believe you already have a clear idea on the impact of interest rates on the stock market. But we also need to know that increased interest rates will have different effects on different companies in different sectors. In order to make a specific response plan, we must understand, in the context of economic recovery and long-term interest rate growth, which industries and companies are favorable to the raise, and which will be most negatively affected. First of all, we must be clear that an increase in interest rates or an increase in discount rate will have the highest negative impact on fast-growing companies. Because for these companies, their future cash flow will be much higher than the current cash flow, and it will be more affected by the increase in the discount rate. Therefore, you will see that companies in the markets that are considered high-growth companies will fall the most in an environment where interest rates increase. This phenomenon has been particularly evident in the stock market in the past 2 weeks. On the other side, companies in traditional and cyclical industries are less negatively impacted by the increase in interest rates. And at the same time, they will be the biggest winner as the economy continues to recover. The increase of interest rates have little impact on their stock price, and it would even promote their stock price. Major capitals are not going to ignore this opportunity. Such an obvious trend will facilitate the transfer of capitals from the fast-growing stocks in the past year to traditional industries with the most reasonable valuation and the most favorable conditions. In my opinion, every volatile movement in the future is only the beginning of higher asset allocation transfer. The markets in the past 2 weeks is a very strong signal. Based on the current market changes, let me share some of my opinions on the investment opportunities in the current market. First of all, during the economic recovery, the cyclical industries are the most favorable under the current environment. The characteristic of cyclical industries is that they are the worst when the economy is bad. When the economy recovers, because they are extremely sensitive to the economy, they are also the most favorable ones. Typical industries in these categories are finance, energy, entertainment, and other traditional industries. For example, an ETF in the entertainment industry, PEJ, has recently risen during last week's market crash. This indicates that many investors have already grasped the trend of asset allocation in advance and laid out this type of cyclical industry. In addition, I'm also very optimistic about the financial sector. For example, bank stocks, as a cyclical industry, can not only enjoy the benefits of economic recovery, at the same time, the increase in interest rate is also good for them because it will increase their interest income. Not only that, because of the nature of bank stocks, they have also formed a hedge against the biggest uncertainty in the current markets, which is inflation. Therefore, we have also seen that while investors have been panicking due to the increase in interest rates, the banking sector has outperformed many other stocks during the crash. The third category of companies that I'm optimistic about are airlines and hotels. For these companies, I made a video in last October saying that they have fundamental problems and do not have the conditions for recovery. And shortly after that, because of the successful vaccine development, airlines and hotel stock prices increased rapidly within a few days. And that was only the first wave. Personally, I would not choose to invest in these industries under such high uncertainty, but for now, I think it is the right time for the tourism-related industries such as airlines and hotels to recover. The last category that I recommend is small cap stocks. For small cap stocks, my current view is relatively neutral. The small cap ETF such as IWM has risen by nearly 50% in the last 6 months. There are two logics behind this. One is that small cap stocks have deliberately increased their losses during the pandemic, resulting in even more stronger upward trend as the economy started recovering. The other logic is that small cap stocks are very typical cyclical stocks. Because the performance of small companies is closely related to the US economy, in IWM, cyclical industries such as banking, energy, and materials are all accounts for high proportion. I also bought some of IWM and I will continue to hold them. But because small cap stocks are very sensitive to the economy, any bumps in the economic recovery will greatly affect it. In addition, it has risen too high over the past 6 months. And there is a certain risk of overestimation. You should be more cautious when investing IWM. Finally, for those of you who have suffered from the volatile stock market in the last week, please don't freak out. First, let me talk about my views on the market. I think the overall economic direction in 2021 is still going well. With the distribution of the vaccine, people are going back to their normal lives. Coupled with the Biden's administration's multiple rounds of economic stimulation bills and the Federal Reserve's stable low interest rate policies, I think the fundamentals of economic recovery are still very stable. In addition, major corporations' latest quarterly earnings are generally beating the expectation. Leading companies are still growing fast and their fundamentals are also reassuring. I am still optimistic that S&P 500 can stand at 4,200 points by the end of the year, which is an increase of more than 10%. In my opinion, the most important thing for investment is to look for investment opportunities with the highest return under the same risk when the market is good. When the market is going down, look for the most certain investment opportunity under the same expectation on gains. As for the current market, I will pay more attention to the later. Some opinions said that the recent crash is a good opportunity to buy technology stocks. I'm not sure if the market has gotten to the bottom yet, but as I mentioned earlier, the decline in the stock market this time was due to a rapid increase in the 10-year bond interest rates, which will lead to the overall decline in valuation, not just a panic selling. I don't know if after more than a week of declines, technology stocks will immediately rebound strongly and then continue the growth pattern as it had over the past year. But something I'm certain is that under the circumstance of economic recovery, the transfer of asset allocation from technology stocks to cyclical stocks is very likely a major trend. Since I'm not sure whether technology stocks will rebound in the short term, I'm not worried about getting rid of technology stocks that I have low confidence will lead me to miss a rebound. On the contrary, for things that I think are more certain, such as the transfer of asset allocation, I will think that doing it earlier is definitely better than doing it later. When I have determined this, I'm not worried about whether the traditional industry has risen too much and whether it's too late to buy now, because I know that I'm standing on the major trend of 2021, so I'm less concerned about the short-term event. So, during the decline over the past 2 weeks, I have sold technology stocks that I feel the least confidence and some of its related options. With the funds and margin freed up, I also bought some stocks of traditional industry that I have always been optimistic about. At the same time, I still retain those technology stocks with good fundamentals, and they will remain as my long-term investment. Of course, these views are very subjective, and investment decisions vary from person to person. What I mentioned about the short-term events in this video, I meant in the next few weeks. And the trend of asset allocation is only the expectation for 2021. If you are a long-term investor on technology stocks for at least 10 years, you can definitely choose to buy now. Personally, I don't want to give up investment opportunities brought about by possible major trends in the short term. And I hope you make your decisions wisely after roughly considering all short-term and long-term factors. If you like my videos, please click the subscribe button. Your supports are much appreciated.